For decades, the United States has relied on one simple truth, that no matter how much debt it racks up, the world will always be willing to buy it. U.S. Treasury bonds weren't just loans to a government, they were seen as the safest investment on Earth. From pension funds in Europe to central banks in Asia, nearly every major institution had one thing in common: they trusted the U.S. dollar. But that trust is no longer guaranteed. Today, America owes over $33 trillion, more than the combined economies of Europe, Africa, and South America. Interest payments alone cost the U.S. government billions every single day, and the figure is only rising. Investors around the globe are starting to ask questions they never dared ask before. What happens if the United States can't pay it back? What if the world stops buying U.S. debt altogether? It sounds impossible until you realize it's already begun. China, Japan, and even close allies like the UK are quietly selling off hundreds of billions in American bonds. The foundations of the global economy, built on the reliability of U.S. debt, are beginning to crack. And if confidence breaks completely, the consequences will be nothing short of catastrophic. For nearly 100 years, the United States has been the financial anchor of the modern world. Whenever nations needed a safe place to store their wealth, they turned to Washington. It didn't matter if you were an ally or a rival, U.S. debt was seen as the ultimate insurance policy. Japan, China, the United Kingdom each poured hundreds of billions into American bonds, trusting that the U.S. government would never default. Unlike corporations that can go bankrupt, sovereign governments rarely fail, especially not one with the world's largest economy and military. This made U.S. debt the cornerstone of global finance. It underpinned pension systems, stabilized foreign currencies, and backed central bank reserves. But this trust wasn't built overnight. It was earned through decades of political stability, military strength, and a dollar that never flinched. Investors believed in the system not just because of America's wealth, but because of its reliability. The logic was simple: if everything else collapsed, the U.S. would still stand. And for the better part of a century, that belief held true. But now, with debt ballooning and political divisions deepening, that trust is no longer ironclad. What once seemed unshakable is beginning to show cracks. The unraveling didn't begin with a bang. It started with quiet exits and uneasy glances. Since 2008, America's debt has more than tripled, climbing past $33 trillion. Every year, the federal government spends over $1 trillion just to service its existing obligations. But the real alarm bells began ringing after 2021. China, once the single largest foreign holder of U.S. debt, began to pull back fast. In just a few years, it sold off more than $340 billion in treasury bonds. Japan followed, trimming its holdings. Even long-standing allies like the UK and Germany began selling. The message was subtle but clear: trust in U.S. debt was eroding. And then came the shockwaves: new tariffs, political gridlock, rise in inflation for the first time in decades. The United States no longer looked like the stable, predictable economic power it once was. What had been considered unthinkable, that America's financial leadership could be in doubt, was now openly discussed by analysts and investors alike. The confidence that had propped up the global economy for generations was starting to flicker. And once trust begins to falter, the decline can come much faster than anyone expects. So what happens if the world truly walks away from U.S. debt? It's a scenario that once seemed too far-fetched to consider, but the numbers tell a different story. Right now, the U.S. government pays around $3 billion a day just in interest, the highest in its history. If the sell-off continues and trust evaporates further, the cost of borrowing could skyrocket. Interest rates would surge, pushing that daily payment even higher, consuming more and more of the national budget. And this isn't theoretical. Over the next decade, Americans are projected to lose over $40,000 per person just to interest payments. That's money that won't go to healthcare, education, infrastructure, or tax relief. Instead, it will flow out to foreign creditors and institutional investors. Already, the U.S. spends 18% of its tax revenue just to cover interest, nearly double that of any other G7 country. Even debt-ridden Greece spends less, and as confidence drops, the damage spreads. Credit dries up, borrowing becomes unsustainable, and the government is forced to make impossible choices: raise taxes/spending, or print more money. The very foundation of America's financial power, cheap credit, global trust, and dollar dominance begins to collapse. What was once unthinkable starts to look terrifyingly real. The moment global confidence in U.S. debt collapses, the effects wouldn't stop at America's borders, they'd ripple across the entire world. The U.S. dollar, propped up by foreign demand for Treasury bonds, would suddenly face an exodus. As investors dump their bonds, they also dump their dollars, flooding global markets with excess supply. The result? The value of the dollar begins to fall fast. And with it, the cost of everything America imports starts to rise. The United States relies heavily on foreign goods, importing over $4 trillion worth of products annually, including a fifth of its total food supply and a quarter of its manufactured goods. As the dollar weakens, everyday essentials like groceries, gasoline, electronics, and medicine become more expensive. Inflation rears its head, not the kind caused by supply chain shocks or energy prices, but a deeper, more dangerous kind, driven by a loss of monetary trust. The cheap credit that once fueled the American dream suddenly becomes a trap. What once allowed the U.S. to spend freely now threatens to choke the economy, and as the world watches, panic spreads. Other countries holding dollar reserves begin to hedge their bets, turning to gold, euros, or emerging currencies. What began as a financial shift becomes a global realignment and America's central place in the world. The economy starts to slip. If this sounds alarmist, history offers a sobering reminder. Just 2 decades ago, Venezuela stood as the richest nation in South America. Fueled by vast oil reserves and flush with investor confidence, its economy was booming on the surface. But beneath that prosperity was a dangerous dependence on a single export and a mountain of debt. The government borrowed heavily, assuming oil prices would stay high and the money would keep flowing. But when oil collapsed, so did the illusion. Investors fled, the currency plummeted, and the economy unraveled. Hyperinflation took hold, people needed wheelbarrows of cash to buy bread. And what was once a symbol of regional wealth became a case study in collapse. Of course, the United States is not Venezuela. The scale, the complexity, the global entanglements, they're vastly different. But the principle remains the same. Confidence is fragile. When it breaks fast. And if it can happen in one of the wealthiest nations in Latin America, it can happen elsewhere, even in the world's most powerful economy. The stakes for the U.S. aren't just economic, they're systemic, because if the dollar falls, it doesn't just take down one country, it drags the entire global financial order with it. The financial crisis has quietly evolved into a national security threat. Years of rising debt and offshoring have made the United States increasingly dependent on foreign-controlled supply chains, especially in critical sectors like defense, technology, and energy. At the center of this vulnerability are rare earth elements, essential for producing everything from fighter jets to smartphones. China, which controls more than 80% of global rare earth processing, now holds a strategic advantage built over decades of U.S. industrial decline. This reliance extends far beyond minerals. The defense industry faces potential supply disruptions. Tech companies risk production halts. Renewable energy efforts, reliant on imported components, may stall. What once passed as economic efficiency has become a liability. In an era of rising geopolitical tension, America's economic fragility is no longer just a fiscal issue, it's a matter of national security. As the crisis intensifies, the path forward narrows to 2 bleak options each, carrying profound consequences. The first, cut spending. On paper, it's the most responsible route, bringing budgets back into balance through fiscal discipline. But in reality, it demands politically toxic decisions, slashing entitlement programs, reforming healthcare, and reducing military outlays. These measures strike at the heart of what many Americans rely on, making them deeply unpopular and nearly impossible to pass in a divided political climate. The second option is deceptively easy: print more money. It delays the pain, props up spending, and keeps the illusion of stability alive. But the long-term costs are severe. Inflation erodes savings, wages lag behind rising prices, and trust in the currency begins to slip. Eventually, the economy overheats, interest rates climb, and debt becomes even harder to manage. Neither path offers relief without sacrifice. The truth is, pain is inevitable. Years of postponing hard choices have left the nation cornered. Without serious, sustained fiscal reform, these temporary fixes only delay a much deeper reckoning. The real question isn't how to avoid the pain, how to face it with foresight, unity, and a plan to emerge stronger on the other side. For nearly a century, the US dollar has reigned supreme, the world's reserve currency, the backbone of global trade, and a symbol of American power. But cracks are forming. As economic instability deepens, nations are beginning to hedge their bets. China pushes the yuan in international trade. Europe strengthens the euro's global role. Others turn to gold or explore digital currencies backed by blockchain, sidestepping the traditional banking system altogether. One by one, countries are shifting their trade deals away from the dollar. Bilateral agreements between China and Russia, or oil transactions settled in local currencies, signal a growing desire to reduce reliance on the greenback. This movement isn't just symbolic, it's structural. The more nations diversify their reserves and payment systems, the weaker the dollar's grip becomes. A multipolar currency world may seem distant, but its rise threatens the very foundation of American financial dominance. Without the unique privileges that come with issuing the world's primary currency, the U.S. could lose its ability to borrow cheaply, sanction effectively, or steer global markets. Dollar dominance isn't guaranteed by might alone, it rests on trust, stability, and leadership. As those pillars falter, so too does the currency that once defined a global order. The warning signs are no longer subtle. Debt has become more than a number. It's a shadow looming over every policy, every promise, every future plan. If the world abandons U.S. debt, the fallout won't stop at America's shores. Markets will ripple, currencies will shake, and global confidence could collapse. The crisis brewing in Washington has the power to trigger consequences far beyond its borders. But this is not just a financial dilemma. It's a test of will, a defining moment. The United States must choose, confront its addiction to debt through painful but necessary reform, or continue down a path of denial, distraction, and delay. The world is watching, the clock is ticking. And so we're left with one final haunting question. Will America find the courage to act, or will the world lose faith first?